Welcome and thank you. Moving on to the session for today, I'm more than pleased to introduce our moderator. He is a lateral thinker, someone who has the ability to use his imagination to look at the problem in a completely different way to come up with new solutions which may not easily come to many of us. It's quite an evolutionary and dynamic way of thinking, the way he approaches problems and solutions. Kushal joined Roland Berger in 2011 and is leading the telecommunications business in the Middle East and also working with several large telecom clients across MENA and Southeast Asia. He has been involved in multiple major mergers and acquisitions, resulting in more than $10 billion investments in and out of the region. Kushal is also a member of the investment committee of the region's largest venture capital company, MEVP, and a co-founder of Dubai Angel Investors. And last but not the least, he's also a charter member of TiE Dubai. Without further ado, Kushal, the stage is yours.
Thank you so much. I think the best part of my journey is looking for founders like Pishu and Sandeep. You know, you have to go everywhere. You have to go everywhere to find them. And when you find them, you don't let go. You hold on to them very tight and you say, "All my money, take my money, take my time." So it's great that we have Pishu and Sandeep here. For different reasons. I think they both come from very different backgrounds. So we will spend a little bit of time on their backgrounds as well, because it's important to know it's not just about raising the money. It's who the people are, what's the product, how did they raise money, why 5 million, why was it not 4 or 6? You know, we want to get a feeling for all of this. So that's it. Let's talk through your journeys, and we'll come back to if the polls are ready. Also, we're going to ask, Cicely will send out a poll to see how many of you are kind of raising money or not, so we get a feeling for the audience as well. So let me first ask Pishu to tell us a little bit about North Ladder, what it is, and what brought you to invest in and build this business.
Sure. Thank you very much, Sean. So the idea really stemmed, and by the way, whilst Sandeep will tell you he joined us recently, Sandeep has been, my partner in crime for, well over 5 years now, when we were sitting down and talking about this. The problem we were trying to solve was not, hey, what startup do we start? It was an issue with people struggling to get access to short-term funding. We've both been in the banking world. We've seen this problem firsthand. And there was quite a bit of data behind it. But one of the things I was doing was serving a few banks who were also looking at microfinance around the world. And that's where we got sort of introduced to the world of how do people access cash. And what you find is the struggle of trying to get short-term funding in times of emergency is a very, very real problem. There's a 2017 report by the World Bank that states that 50% of the world's population is not able to access 2 weeks of their salary in an emergency. And of the remaining 50%, only 25% are actually served by formal banking institutions. The rest of them, pretty much 75%, depend on family, friends, selling something. So this is clearly a problem. And this is 2017 in the pre-COVID world. So we knew we had a big problem. We knew it needed a completely different way to solve it. And that was kind of what the push was. So I remember sitting and working with Sandeep many hours over a number of shishas going, how do we crack this? That was the sort of genesis of this idea.
So just to make sure that we get your backgrounds as well, we're normally used to founders being 17 years old or 20 years old. So give us a little bit of background of
Right. I'm gonna ignore my age, except that I'm on the slightly north side of 50. But I've been in financial services pretty much my whole life. I started off my career in Reuters, where I was responsible for treasury and risk management. So that's where we understood, how the entire financial markets work, and that bears relevance to how North Ladder got started. But I then also moved on to work with one of the largest banks in the region. I was their head of IT operations for Emirates NBD, and was there when the merger took place with National Bank of Dubai. I then served for about 5 years with McKinsey and Company as a senior consultant, again responsible for operations and financial services around the world. And it was roughly there where we came up with this idea, and we wanted to do this. So I moved from there to head up the operations transformation globally for MetLife. And while doing that in the nights, I was moonlighting, trying to build this platform to see how we could make it work. So that's sort of my background in a nutshell.
Sure.
Sandeep?
So, I started my career with the G Capital or Genpact, as it's now called, the global outsourcing services of GE at that time. And I served some time in India, and then I moved to the US to start their consulting practice. Spent a few years there, joined McKinsey and moved to Dubai. I was, a senior consultant in McKinsey for a few years here. And as part of that, began my entrepreneurial journey. I created I built a business case to create a third-party shared services company for Emirates NBD, which was supposed to go external and serve clients across the Middle East. And so I left McKinsey to set up that company at a Skulk and Feed. It was a fun journey. We set it up, 3,500 people, completely world-class operations set up at that time. And then went on to do lead the digital transformation for the bank for a couple of years more. And then joined Kareem. And I joined Kareem in an operations role, but graduated to becoming the managing director for the whole ride-hailing business as Kareem were into food and deliveries. So I was managing the core P&L, including all of tech, operations, marketing, everything that came with the ride-hailing business. So did that for, the timing was great. The Uber deal happened within 18 months of me joining, stayed on for a couple of years more, and then wanted to do my next stint. So that's how so literally last year when I was toying with what next, I was surprised by the conversation that I had with Pishu 5 years back about this idea, how much it had evolved. And it went from a surprise to getting intrigued to finally within a month saying, okay, let me do this again, right? So I jumped ship and I decided to, it was really exciting to see what they had built, the product market fit, etc. So that's when I decided to jump ship and join them full time. 7 months.
I must say, both of you must have this this disease that says, I want to work really hard. Because setting up a business is not, you go from a unicorn to jump into yet another startup.
That's what I told some people. It's time to be poor again.
Exactly. So what's the relationship between the two of you? How do you fit with each other? Is there kind of yin yang between you, or are you playing the same role? What kind of roles do you play?
Yeah, so I play the CEO role, and Pishu plays the Chief Operating Officer role. And to that extent, I focus more on the long-term strategy of the company, the direction in which we need to think. Also, the overall guidance to the product org, etc. And of course, all the external relationships, especially with the investor community and stuff. As Pishu manages the core operations, and then we have a separate team for tech, etc. So that's how we have very clear demarcation of roles and responsibility, but obviously on all the key decisions we're joined at the hip.
Yeah, well, but when I go and invest in companies, it's not just the roles are different, it's that the personalities have to be different. Tell us about your personalities. What's different about the two of you?
So I think he's too modest. That's why. I think I'll give you an example. So I like the details. I work with the details and I try and make things work. And if you left it to me, I'd probably spend the entire time, in the lab trying to continuously improve and make it look better, and get it to work. So much so that we were very, very focused on the fact that we were going to serve the short-term lending market. It's only when Sandeep came along and looked at the big picture on this, and there were two big insights that frankly, I was too close to the problem to see. And big insight number one was, guys, this is a eminently highly scalable global platform that we can scale fast. We knew it was scalable. We knew it was going to be global. but the speed at which this could move was something that, sort of Sandeep had the vision saying, look, we're gonna make this go bigger. And by the way, what we built serves a couple of other larger markets that we hadn't looked at. So I think in a nutshell, the big picture direction is what Sandeep really brings to the party. And what we're able to do, what I'm able to do is to sit and figure out how is all this going to connect and work together. And that's critical.
Great. Thank you. So look, we have a lot of new participants that have just joined. Just to make sure that they all understand North Ladder, can you guide us as a customer? If we were customers, should I be selling all my wife's gold and coming to you and here, take my gold, and should she be selling my Rolex watch, or what is it that you do?
Not if you want to stay married too long. No, so let's look at the problem, right? If you wanted to get cash quickly, you have two choices, right? One is loan sharks, which is always a problem. So aside from the banks are always the best option, but the banks have their own challenges before they're able to give you money. One thing a bank is always going to do is look at your ability to pay back. So institutions underwrite people and people's propensity to pay. If you move out of that paradigm and go, well, what else can I do? I want to take money against collateral. The ability is to underwrite the collateral. So for short-term funding and for small values, you're pretty much limited to the equivalent of pawnbrokers around the world. Now that has 3 or 4 challenges. Number one, you get very little value for your asset. Aside from gold and jewelry, which has a market value, which probably gives you the best loan to value somewhere in the 65% sort of range. The moment you come out of that, if you look at other assets, including luxury watches, electronics, etc., you're getting 25 to maximum 30, 40% loan to value. So that's the first problem. Second problem is there's no price discovery, right? You can't go shopping from one pawnbroker to the next or the third. Whatever you walk in, you do, which means you are very much left at their mercy and their discretion on what they want to offer you, right? Third one is interest rates are fairly high. So what it costs, whatever it does. And our research shows us, even in countries where pawnbroking is highly regulated, the total cost of the service will be anywhere between 250 and 400% a year is kind of what you pay, for service fees. And finally, there's the whole sort of taboo around walking into a pawn shop, being seen in a pawn shop. And certainly the moment you climb up a little bit the pyramid, you're not going to be able to do this. So these were sort of the challenges. The way we've sort of twisted this around is we've removed the pawnbroker from the picture. And we've brought in a marketplace that has end dealers who compete to give you the highest price. So that way, instead of getting your 25 to 30% loan to value, you're getting anywhere between 80 and 90% loan to value. And the second thing is the service fees themselves are actually quite manageable. So they're somewhere around a quarter of what a pawn shop would charge you in most places. But the most important one is complete discretion and dignity. For you to execute the deal, you walk into a retail store. So if it's electronics, you're walking into a standard high street shop. You could frankly bump into your best friend and all you're doing is selling your asset. There's no sort of taboo around that. If you're doing a luxury watch, you're dealing with the ultra luxury ateliers like Frank Muller, the likes of that level. And it's all super secure. So it's all handled by experts, stored in a very secure way. So it essentially brings a lot of those benefits to someone who's looking for short-term funding. And we see our clients really take up to that. And we'll talk about
and Kushal, essentially, if you look at the customer journey, back to your earlier question, all you would do, right now we deal with electronics and watches, luxury watches. So let's say you've got a luxury watch that you want to get cash against. You would submit a quote on the website. We would give you a price quote within 48 hours at max. We run a global auction and we tell you, hey, let's say we'll pay $10,000 for your watch. But obviously the biggest, it's conditioned to your watch being checked, right? It has to be authentic. There are no damages, etc. Then you walk into one of our ateliers that we have a partnership with. They test it, and then we're able to transfer the money to you. It's as simple as that. In 30 days time or 60 days time, whenever your buyback period expires, you can come back and take the watch.
Excellent. So basically, you're removing friction from basically the buying and selling of assets for customers. So now let's switch to the money side of the discussion. So before you raised the 5 million, how long was the journey? How did you kind of take it to that point when you, so we'll talk about raising the 5 million in a few minutes, but let's talk up to that point. How long did it take? How stressful was it? Just walk us through that journey.
So actually our angel raise was one of the things that gave us quite a bit of confidence. Our angel investors are all very seasoned people. So they're anywhere from, CEOs of unicorns, very senior partners in some of the top consulting firms, very senior bankers. And we've gone and spoken to all of them with this idea, saying, hey, this is what we're thinking of doing. And it was actually not much of a challenge, primarily because people completely understood what we were trying to do, how we were trying to do it. By then we had done, the initial investment was myself and our third co-founder, a gentleman called Ricky Husseini. So we put in our own money to start with. We built the platform ourselves. And it's only after we'd done a few hundred deals that we knew it's working. The customer experience is very smooth and nice. People like the way it works. And the deals are profitable at the unit level. When we went with that data, most of the angels we spoke to got it straight away. So actually that wasn't too much of an issue. We raised about $1.2 million as our angel sort of raise fund 1 year into the journey. So the first year we funded this ourselves.
You were lucky enough that you knew you had let's say a network of such angels, etc., which is maybe not always the case for other startups. But I like what you've just described. You said two things came true first. You had a user experience, customer experience that was neat. The product fit. You had a few hundred deals, so that meant the proof was already there, and the unit economics were already positive. So that makes the credibility substantially different. How long did it?
It wasn't really family and friends. They were all very seasoned investors who understood what the value proposition was. So I agree the network helps, but I think it's also the facts on the table that kind of sold the story.
So I think for the listeners, we're talking about the narrative cannot just be a narrative without some backing, and the backing here is very much financial unit economics driven, and the fact that it's working. Yeah. Anything else that convinced actually that 1.2? How long did it take? So at what point did you start after the year? Was it 1 month, 3 months, 6 months that it took?
We started the fundraise at the end of the first year of operations. So we started it, I think it was somewhere towards the end of 2018. And it took us about 4 months or so between various angels to collect up to $1.2 million.
Again, just for the listeners, having been through this or on many sides of this journey, this can take anywhere up to 18 months if you're unlucky, or it will never happen. And if you're very lucky, it can happen within 1 or 2 months. Now, our perspective is that second-time founders or those who have, let's say, the history, it's much easier to raise because there's more credibility. Now we're talking about seed. So now walk us through the 5 million discussion. So that obviously comes from a seasoned VC who you may or may not have known before, but walk us through that journey and how easy or tough was that, and how did you get to the valuations, and how did you decide it's 5 versus another number?
Yeah, so I joined formally in August last year, but I had started doing my own due diligence before joining back in July last year, right? And what appealed to me was the same thing that we pitched to the venture capital firms that we were talking to at that point in time. So multiple things that struck me about the product and the company, right? One was that, the product market fit was established. We had done like 10,000 transactions, and in a very beautiful way, customer experience was phenomenal. People were rating us like 4.9 and 5. The repeat rate was very, very high. So that was a great, customers love your product. You've done a product market fit, the first level check. The second thing that I liked was unit economics was positive from day one. From every deal, we were making money. Of course, you're not making EBITDA profits, but you're just unit economics positive in every deal. And that was very encouraging. Third, we love businesses that are technology focused, that can be scaled with tech. This had all the components of, and which is why we believe we can actually scale very rapidly globally with very less people. It's a tech scaling this thing, and the team had spent 2 to 3 years building great tech, right? So that is the third thing that I really like. And there were multiple. I mean, essentially with these three things, and then with the capital efficiency, it was just a question of then going and convincing the venture capital firms that this is worth making an investment, right? So that's how I came. And I also like the fact that it is a global model. I mean, it is not a model that would be limited to just being part of the region. And it was a sense of pride saying that, hey, can we take something from the region to the US, to the rest of the world, right? And it has not been done before exactly in the same way we are doing it. So there are multiple boxes that this checked. So armed with that, August, we started the process. We were lucky. I think we were one of the lucky ones that you mentioned. By mid-September or end September, we had an indicative term sheet, within 2 months, 6 to 7 weeks actually. And then it's taken us all this time to kind of formalize this thing. Then we changed the name. We were called Buyback Bazaar till last year, right? So one of the first things that we did after I joined was also, in the light of the strategy, we realized that, hey, the word Buyback Bazaar was initially coined with the intention of it being only a pure buyback business, but the infrastructure that we have built, we think can pivot and start disrupting many other industries. I mean, I'll save that for some other day, but essentially it's a far bigger business potential than what we had originally envisaged. So we thought that the name was restrictive and we wanted a universal name. Initially, the plan was to be more focused on the region. So even the word bazaar was more focused on that. But if you wanted to go to US, Europe, and the rest of the world, we wanted a universal name. So given all that, we quickly changed the name. So we're waiting for the name change, the website change, the UX, UI change before we did a press release. So that's the whole journey. On why 5 million and not anything else, again, we went back to, instead of, I think, having this typical mindset saying, hey, let me raise 1.5 or 2 and anecdotal this thing. In fact, we built out an entire model saying that, hey, how do we, one of the things I said about the business, it's a truly capital efficient business. So we said, how do we go from, if you really want to make a globally scalable model, how do we test this in a couple of countries, right? Like, let's say Saudi Arabia is obviously the natural expansion strategy in the region. But if you want to actually even pilot it in the largest market, which is the US, how much capital will we need? What kind of GMV can you end up in 18 to 24 months, so that the next set of investors can come in and find it exciting enough to invest, right? So we did a bit of those simulations, and that number came to around 3.5 to 4 million. And then we said, okay, let's take a 20% buffer and go with a 5 million number, right? So that's how we came up. I think I want to emphasize the whole capital efficiency. I think we still believe that the 5 million can take us a really long way. Depends on how quickly we want to scale or how slowly we want to scale. We can actually take it to EBITDA profitability with 5 million if we want to, and then grow slowly. Or we can have a choice to do a couple of more rounds of fundraise and grow more rapidly.
So given, let's say, the sexiness of the model, did you have VCs fighting over this? Did you have more than one term sheet? How did you decide which VC to go with, etc.?
Yeah, I think that's a great question actually, because we didn't go and approach everyone that we could. We obviously wanted to go down in the pecking order. Beko was a very natural choice for anyone in the region, any entrepreneur in the region. Beko is one of the, given the success that they've had. And, for us, and I learned this from my Kareem days and even my experience before that, is that it's not just about the access to the money, right? Capital is one thing, but an institutional VC brings a lot more to the table. Frankly, capital, we could have gone back to our angels and raised maybe not 5, but maybe 1.5 or 2 that would have kept us going for another 1 year, right? But I knew the value of institutional capital, which is just advise on what's the best way to scale, because they've seen so many more startups compared to us. Help with the next round of fundraise, help with expansion, opening doors with government, with corporates, with stakeholders, a lot of that. So literally a partner in the journey rather than someone who's just providing capital passively, right? So I think given all those criteria, I think, and for me, honestly, that was far more important than the capital or the dilution terms that we agreed. So we were, I mean, like theoretically, we were willing to dilute a little more for the right partner because we knew that the probability of success becomes so much higher with the right partner. So we started with the best ones, Beko obviously being among the top, and we were fortunate enough to close something within 6 to 8 weeks. So which is why we didn't have to go too far.
Excellent. I'm going to switch away a little bit from this discussion. Just to throw some fun into the discussion, what's the funniest or craziest item that's been sold on your network?
If you can answer that.
Oh, I'm going to throw you a trick question here. So we do luxury watches, we do luxury cars, and we do electronics. We've done things like Ferraris and Porsches and cars like that. So here's a guess. What would you think would be the most expensive asset we sort of helped fund?
You pointed me towards the car, which makes me think it's not a car. So it has to be something rare, right? Yeah.
It was a watch that's probably worth my annual return on anything I've ever done. But the one thing that we the joke aside, the one thing that we learn out of this is how important it is for people to be able to sort of protect their assets, because these are all very aspirational assets. There's a lot of emotion involved in it. It isn't just a watch or just a car, right? It's something that you spend a lot of your hard-earned time, effort, money, thought, dreams, etc., and acquired. And now, just because your back's against the wall, there's a risk that you're going to lose it. And the ability to not have to do that is actually huge.
Actually, I also, it emphasizes the name North Ladder, right? So it's the appeal of going up the ladder, I guess. Yeah, how do you ensure that both your customer and your investor, your two biggest stakeholders, feel very comfortable with you? Because the customer is kind of saying, hey, by the way, if I've got my money back, I would like to buy it back, or don't damage it, or I don't know, give me a decent price, don't mistreat me, etc. How do you ensure both sides are very comfortable with you?
Comfortable. So three things. Number one, the customer knows that the price is a competitive process. It's not something we set. And by the way, we make no profit from the price itself. We charge a platform fee. So it's in our interest, and the platform fee is a percentage of the price. So it's in our interest to get the highest price. So number one, that there's no conflict of interest from that side.
Yeah.
On the other side, on the member side, the answer, and this comes from our financial background, the only way to get a true market is transparency and competition. You have to have those two. And we've built a transparent, competitive environment where prices are visible. Everyone knows what the best is and they know what they have to beat, which is what an auction brings. Number two, that we never hold, touch, or own or keep the asset ourselves. The asset is always managed by an expert or a specialist, stored with that specialist throughout the entire process, and is kind of sealed and tamper-proof where possible. I can't seal a car, but the way we protect a car is the license on the car doesn't allow you to drive it on the road, so you can't actually drive it. But it's owned and stored, in a protected environment. In a watch, it's owned by one of the top brands, around and stored in their vault. We never touch it. From the shops or the dealer's point of view, the benefit here is that the ownership of the asset transfers on day one. So there isn't any issue tomorrow if the customer decides not to come back. How do you repossess? There's none of that, right? You already own it. Yeah. It's a matter of just selling it, and sort of doing that. But the most important one, because there've been a couple of times where customers had to let go of the assets, and we had to remind them, hey, remember, you got market price. It's not like you got taken to the cleaners. Your back was against the wall, and that makes a big difference.
Excellent. Let's go into the expansions. So you're going to potentially, I think you mentioned you would go beyond. Are there also product expansions you'll go into? I've seen these stories around NFTs and I don't know what else is out there. So art, non-fungible, something that's hard to price. hard to put a value against.
So absolutely. So in terms of geographic expansion, as we speak, we're expanding into Saudi. So that's the first port of call. We've also already set up a US license, but US is going to be not a big focus for this year. We're probably going to do a product market fit and do the first few thousand transactions there this year. That's the aim, but really scale US next year. In terms of products, as you can imagine, you're absolutely right. Once you've got the product market fit and you've got the basic operating model in place, on luxury assets, you just have to expand the asset class, right? It's a bit like, financial institutions think about introducing products, right? So if you're, once you're doing a watch, you can absolutely go into handbags. You can go into, branded jewelry. You can go into any other asset class. I just want to make a distinction here, though. We're not going to get into the art and unbranded assets because we deal with branded commodities that can be globally traded. That's the underlying principle behind all our asset thing. We like to deal in assets that you can find global buyers and you can commoditize it, right? So meaning you can standardize it and you can put a price on it. Even a Rolex, right? It could be like $50,000 worth. But at the end of the day, it has an SKU and it has a price that anyone in the world can understand what that is. It's the same thing with art, right? So that's the only distinction. But otherwise, practically anything that is a brand name and has a global marketplace, you could expand it.
I'm going to shift to the questions from the chat in a second. But one question around regulations, because you're kind of flirting with touching the regulations and just staying a little bit far. Can you walk us through that fine line of are you regulated, unregulated? How do you stay away from issues such as money laundering and all the other elements that come with this?
Yeah. So from a regulatory point of view, we were very clear in the beginning is that we wanted to make this not under any circumstances a money lending operation. It's an outright sale of an asset with an option for you to buy it back. It's been given a forward price, you're not paying anything for it. So you're selling your asset at market price and you've got, with a marginal profit, you've got a price in your hand, at which if you wish, you can come and buy it back. So that operates very much like a trading entity, the way it does. It's a goods murabaha. We were also, although in a lot of places, it's not like you need the stamp of Sharia approval, but we wanted to make sure it was very ethical on that aspect and how we ran it. So the service fees as such are marginalized, but they pay every member across the value chain. You've got the guy who's setting the price, taking the risk, storing it, assessing it, insuring it, etc. All of those people are paid together in one price, which is the profit margin you add on top of it. Number two, in the event that the customer does not buy back the asset, we do not take any other profits or anything ourselves. It's owned by whoever put the highest price, and they're the owners for them to sell it and take it on. So effectively, this functions as a technical platform that is supporting a trading market where shops are able to buy and trade amongst each other.
And so the regulator never, you stayed away from needing regulation.
Well, we spoke to the regulators in the UAE before we went into it, and there the clarity was, well, we see a technology platform, we understand the e-commerce side of it that you're running, and you're trading assets. As long as the customer is very clear that I am selling my asset, I am not borrowing money against it. This is just a straight sale. Now, when
I'd like to see that happening in the KSA.
No, we've had conversations with people from NISA as well, and explained the model in detail, and it's pretty much aligned with where we're headed. You talked about a couple of things, which is money laundering and stolen goods and things like that.
Yeah,
we follow the market norms that are in place already. We trade in existing second-hand markets that are quite vibrant. Let's take electronics for a moment. A lot of people don't know this, but the UAE is one of the largest traders for second-hand electronics. And the second-hand electronics market in Dubai is about 5 times the size of the primary market, roughly. This is a rough estimate. It's a huge market. Yeah. We trade the way they trade right now. We're not introducing a new risk or circumventing that. There are very clear rules by the government on how you buy and sell second-hand equipment, including CID checks, etc., for high-value assets. And our traders follow exactly those rules.
Excellent. I'm going to shift to questions, and then we can, and I let you be in an open conversation. So if I look at, we may or may not answer all the questions. So the first one around anonymous attendee saying, your margins are much lower than, let's say, the banks, etc. Is it because the cost structure is higher, or are they just charging a big spread? I'll let you figure out how you want to answer that.
I don't think our margins.
Sorry, where's the? I don't see the question.
Under the Q&A, what are you doing to take out the costs of existing models like the banks and the pawn shops, etc., which I assume is the digital side, and what allows you to give a better loan to value than they do?
Yeah. So let me answer the question. Saying right. Any day. So let's talk about loan to value. The reason, and let's take an example of the US, which is the biggest pawn market in the world, right? In the US, there are 11,000 registered pawnbrokers, and 30 million Americans use pawnbroking services in 2019, right? So I don't even have the numbers for 2020. So what happens in the US, and our model can give us better LTVs compared to even US pawnbrokers. The reason is very simple. The US pawnbroker is basically a money lender, right? And like any money lender, they're interested in getting their money back with a high interest rate. They're not interested in the underlying asset itself because they're not dealers of the asset. The pawnbroker will accept everything from a lawnmower to a gun to a watch to a phone, right? And they're not dealers of all these assets. And which is why what they do to protect themselves is they take a very, very low LTV. So they'll say that, hey, your watch is worth $100. Let me give you $25 because, you know, even if 4 times the cover, even if you default, I know I can recover 25. That's the mindset, right? And because of which the customer loses out because you're getting a very low value and you're paying high. We have kind of taken it a very different spin on it and said that, hey, if we connect with the dealers of those particular assets, right? So instead of giving you $25 against your $100 watch, if I connect you with a network of global watch dealers, they'll be happy to buy it even at $80 because even at $80, if they acquire it, they can sell it for 100, right?
They have a margin.
You as a customer. So that's what we've done fundamentally, and that's how fundamentally, if you look at even asset-backed lending in banks, I mean, having been a banker for many years myself, I can tell you that banks also do personal underwriting, and they're primarily interested in individuals returning the money on time. They're not interested in the assets defaulting and then making a profit from that, right? That's not the primary thing, right? In our case, we have no assets on our books. It's the underwriters who are kind of picking it up, which is in this case the dealers. But we have every incentive because of the competition that we've built in to give the highest LTV to the customer. In terms of cost of financing, again, if you create a marketplace around funding also, even in the US, we can absolutely lend at a fraction of the cost that pawnbrokers do. You can never lend at the cost banks do. Banks would always be the cheapest source of finance in any market. But please remember, in the US, if there are 30 million people who are using pawnbroking services, these are people who have a poor credit score and cannot access the financial system. And this is true in most countries of the world, right? The formal financial system addresses a relatively small portion of the population, right? And that's the reality.
So I'm going to skip the next 2 questions because you've kind of explained that your business model, you're not taking the underwriting risks, so you've already backloaded. So I'll skip those 2 questions. There's a very good question here. Before you got your angel money, the 1.2 million, what was the level of investment you had to go through? How much bootstrapping was required? And I guess that's a very important question for anybody entering this space.
Yeah.
So I think between, in the beginning when we launched, between Ricky, Husseini, and myself, you're looking at probably about $250,000, but 2 years without a salary and lots of shawarmas instead of regular dinners. So it's quite tight.
I think that's that's when you had a unit economic in a business model where you knew that your unit economics from the get-go could be positive.
Yes.
Many startups start with the unit economics are negative, and you have to have a certain scale. And
yeah, no, that was clear from the beginning. We were very clear that we wouldn't approach any of our potential investors till we could prove, number one, customers really liked it. Number two, it made money. Number three, it could be scaled and the tech was working. And that's why for that we were ready to put in that money and lose it if necessary. to see how that happens.
And I think for everybody here, that 250 number that you and the 2 years of shawarmas or shorts and all, whatever, that's a number everybody needs to keep in mind. That's roughly you know, on a good scenario basis what you have to think about.
I think
So-
the one positive story there, Kaushal, which one anecdote that comes to mind, when I wanted to quit my job to go and do this, I went and met my boss. I had to fly down to New York, and I met him in New York, and I sat and I said, listen, he had actually called me in to talk about my next job, and I was going to move up to SVP and all of that stuff. And I sat there and I said, listen, I'm leaving. He goes, what do you mean? How could you do that? I said, let me tell you what I'm going to do. We sat down and had breakfast in New York. I said, this is what I'm going to go and do. He looked at it, because by then I kind of got a bit of an app set up with my team, you know, working. So he looked at it, he said, okay, absolutely, you quit. And by the way, I'm putting the first $100,000 myself. You know?
Brilliant, brilliant. Okay, there is a question around, and you're not forced to answer it. What valuation did you raise your 1.2 at? The angel.
The first round?
The valuation.
The first round.
20%.
Yeah.
We diluted around 20% at that time.
Pretty much in
Yeah,
line with
okay.
Series A, right?
No,
Yeah,
this
yeah,
was
sure.
the
Oh,
angel was
Yeah.
oh, the angel.
Yeah.
Yeah, I think
So-
most angels
20%.
didn't care too much about that.
So I think, again, for the audience, typically the dilutions always, whenever you do a decent size round, the dilutions in that between 15 and 25%
That's right.
range. That's a standard.
That's right.
Let me go to the next one. Did you have a specific approach to how detailed your financials were for each round of fundraising? I mean,
Yeah,
guess.
I think it's an important part of the thing, right? I mean, of course, we had the advantage that, you know, I'd done a lot of the fundraise conversations even for Kareem. So I had like hands-on experience, and even before that in McKinsey, having built business cases, set up a company in the past, etc. There's no question that these things come in handy when you're dealing with, you know, investors, right? So if you don't have the skills yourself, my advice is just make sure that you've got access to some freelancer or someone who's helping you do the financials and be able to present the story in a very articulate way, because venture capital firms are going to be busy. They're screening multiple investments at the same time. If you're not able to clearly articulate your financials or your strategy, you know, even if your business is a fantastic value proposition, you're just going to lose out on the opportunity. So that, I mean, honestly, in our case, you know, that's what I did in the first 2 weeks of joining. 2 weeks, just dedicatedly sat down, reworked on the financial model, reworked the entire fixed deck, and then the next 4 to 6 weeks closed the investment, right? So that's a typical size.
And as an investor, again, to the audience, we hate to see messy books, or we hate to see a lack of governance. So those are, for me, hygiene factors. So get the hygiene factors. So let the investor focus on the product or the story or the growth, not the not trying to understand the numbers, because that'll be horrible. Yeah. Somebody's asking, would you ever use an agent to raise money, or do you go direct?
We went direct because, again, right, we had access to the thing. I know of other entrepreneurs who've used agents, but I mean, you know, I personally don't have any experience of doing that. But we're fortunate enough to go directly and be able to raise money.
Okay, so from Roderick, how did the ethical framework look like at inception, and did you change it? My assumption here is not just the ethical framework; it's your whole DNA, it's your brand positioning, etc. So, yeah.
Well, I don't think, I think who we were helping and how we were going to help was very clear from the beginning, and that hasn't moved at all. The one value that we value the most is any service we structure, and that's something we've actually written down as part of our values. Any service we structure, every person in that value chain has to benefit from it. Otherwise, we don't want to do it. So this is a complete, you know, it's a triple win. It's not win-win. It's all the way down the line. Otherwise, you know, it's not a zero-sum game, and it should never be.
Excellent. There's a question back to the underlying product. When there's a buyback option on the product, how do you or your underlying suppliers honor the risk of the buyback price?
Yeah. So essentially, what we do is very simply we get a price from the market, from the dealers. They're giving you a forward price essentially. So someone is saying that, hey, if this is a phone, I'm ready to buy it for 1,000 dirhams a month later, right? If the customer wants to buy it for 1,000 dirhams, the dealer is willing to pay the price, and we actually pay them a premium to hold the price, right? In return, we've got security deposit. We have a lot of these institutional mechanisms. We've built it pretty much, based on Pishu's experience, our experience in financial services. It's how option markets are built, right? It's option.
No, fair enough. Let's go look forward. How big do you want to become? What will be your exit plans? How long?
Yeah, I have a pretty philosophical view on this, that you can't just peg a number and go after it. I think the market is massive globally. It's probably a few $1 trillion in size. This whole informal lending sector, asset-backed lending, the pawnbroking equivalent. In most countries, it's illegal. In countries where it's legal, it is billions of dollars in size, right? So when you're entering a market that is so big, I mean, honestly, we don't know where we're going to reach, right, in a few years, right? We want to take it one step at a time. I think we're very focused on a few things, right? One is we're very focused on reaching and positively impacting as many people as we can, which is in line with the mission. So we want to find a way to rapidly scale this, right? So we're opening 2 countries this year, but once we've cracked the model, can we do 5 next year? Can we do like 10 the year after, right? We think it's doable. We think we can run cities with like less than 5 people or 5 to 10 people in every city. And to that extent, it's absolutely doable. And that, if you really put that into consideration, then, and the fact that we want to be as capital efficient, not burn a lot of capital. Hopefully, one more success metric that we want to buy for is that we're not raising too much capital in this whole journey, right? Maybe 1 round, 2 more rounds, and then we are in self-sustenance mode and growing for a long, long time, right? So we don't have this thing like, most people had, even including me in my earlier entrepreneurial journey, the magical $100 million number or $1 billion number, which I think is just some random figure that you're chasing, right? So it has no meaning otherwise.
I think one element to add here, Kaushal, literally the first 500-600 customers that we dealt with, we called every customer up. Yeah. And we asked the question. I personally did that. And the question I asked was, I'm sure you like the service, all that stuff is great. We can fix UX, la, la, la. Why did you need the money? Can you tell me why you needed it? And can you tell me what would your alternatives have been if this service was not there? And I was very clear on why I was asking the question. We want to make sure we're serving a real need. We found the top 3 reasons people needed to borrow money. Number 1, at the lower end of the market. Number 1 was the rent is due. Number 2, I've got a medical emergency. Number 3, I've got to send money back home. This is pretty much the top 3 of the 5 reasons people desperately need money. All of these are non-discretionary expenses. Non-discretionary expenses means at that stage, I'll sell my kidney if I have to. I have no choice. And that is the gigantic market that we're looking to serve here. So the reason I say this, anyone in the audience over here thinking, hey, my goodness, how do we copy this? Come and talk to us. We're not really worried about, being the owners of this IP for the rest of the world. It's too large. And there are too many people who need this help. It's like trying to say you're going to be the only restaurant on earth, right? It's impossible.
Or the only bank on earth.
Or the only bank on earth.
Yeah.
But the need is big. So guys, if you had your country and you think this would help, come and talk to us. We'll help you figure out how to get going because people need the help. And that's really what's driving us here.
I love that. So look, I think from unless you want to have any other statements, Cicely, I don't know how this works. Do we open up for direct questions, or we just base it on the questions that are coming through?
We can do that for a couple of minutes if there's anybody who raises their hands and wants to ask directly. We do have 6 minutes left.
And Roderick, thank you for the comment. That's very sweet.
Akash Babu wants email ID.
I guess you can type that in the email ID. If I let responses go through
It's
the chat.
just our first name at northladder.com.
Yeah.
It's just both our first names at northladder.com. Very simple.
Akash, they don't buy kidneys yet. Um,
And I think, Kush, there are questions for connecting to Dubai Angel investors as well.
yes. So again, I will put my email ID in there as well, so we can go through that.
Okay, I can share that.
Exactly. Look, I like this triple bottom line kind of feeling around it. It's not a triple bottom line relating to environment, but it's still an ethical triple bottom line, which is changing what is otherwise a notorious industry, or at least by perception, a notorious industry. So you're making it more transparent, more real, more positive for the customer. And I also know that, I guess, from your backgrounds, the people you worked with also had that attitude to say, hey, how do we resolve frictions? It's all about customer frictions. How do we fix it, and how do we fix it? And that's always the end DNA around this. Any other advice you would give, especially around raising money, about the stress of the first 2 years? What advice would you give to the audience?
So when it comes to working with people, and I think we can say this about Beko, the best part about working with Beko is there's a bit of a meeting of the minds over here. They share the dream. They very much share the aspiration. I think Danny is a phenomenal guy to work with. If anything, even more aspirational than we are. He literally, the plans were huge, and let's go for the big picture here and get that done. And that is phenomenal. We bring that into consideration whenever we look at people even joining the cap table. Right from the beginning, we were very careful to make sure you had people who at least aligned with your values and your ethics. It wasn't just about the money. And which is where, I'd hesitate to bring in an agent, because it really shouldn't be a transaction just about the money.
Specifically, Kushal, to your question, I think, my advice to entrepreneurs will be just focus on building a great product. And, we all know this, but it's still important to kind of reflect on it, that post the WeWork era, I think, as an investor, Kushal, you will subscribe to this. I think gone are the days when people looked at growth at any cost, because it's easy to kind of spend $50,000 on marketing every month and, get the growth going. But, if you're getting growth only through throwing money on the problem, that's not a real product market fit, right? So if you build the right product market, the right product, if you show that your unit economics positive, if you build moats around it, show that there's a global market for it, or the market size is big enough. And then if you have the right set of people, then, the actual growth rates don't matter as much. I'll give you our own example, right? I think, the team had rightly so focused on building the right tech. We then had to go to the investor and say that, hey, the market is massive globally. We have the tech and the product, and here is product market fit over the last 12,000 deals, right? I mean, with this kind of customer service rating, etc. The growth rates didn't matter at all. And we, till now, we just have one marketing person in the team. We are organically growing, despite that, 15% month on month, right? And we know that if we throw a lot of marketing dollars, this is going to boom, but that's not the point, right? So that's what I would say. Really focus on the fundamentals, because it's all about that.
Yeah, and if you make mistakes, learn fast from them, right? Just yeah. Ivan had his hand raised, so I'll let Ivan ask the question there. But at some point, if it's possible, we still have a couple of minutes left. Is also, what did you do on the ESOP? Did you leave enough ESOP, etc.? Tell us a little bit about that.
Sure. No, I mean, on the ESOP thing, I'd seen it firsthand in my prior experience. But even otherwise, right, we know it's a well-known fact that you can only create value for your shareholders if you share wealth amongst your employees. So I think philosophically, we're completely aligned. We've carved out a double-digit percentage for employee stock options. In fact, we are actually putting the fine print on the stock option policy now, and we want to make it as liberal as any Silicon Valley would make it, a company would make it. Which means, if the company benefits in any which way, every single employee should benefit equally, right? So there's no question, no no surprises, no terms and conditions, no no way for us to kind of hold back value from the customer, from the
Quadruple bottom line. So, Ivan, Ivan, you want to ask the question? I don't know if you're. I can't see.
Yeah, he can talk. Ivan?
Hi. Hi, Kushal. Yeah, nice to see Sandeep and Pishu. For me, it's the second time I'm listening to North Ladder in a month. Last month, I hosted a session with Ricky.
Ah,
And this was just a week after you got that $5 million deal. So it's nice to see you all, and so pleased that the local ecosystem is now getting into really tactical ideas that can go global, and a lot of VCs are now chasing entrepreneurs. That's a very nice situation to be in. The general trend in this ecosystem here was that you cannot go global, and the size is too small to scale. So I'm pretty happy that you are looking at larger markets and really taking it to a global one, having your incubation done in Dubai. Congratulations.
Thank you.
Brilliant. And yes, this let's call it. They're part of the Karim mafia in some ways. So we did a little mathematics that says that every startup average, not of course there's small and big, but the average startup creates roughly $1 million of GDP impact per. So if we have 1,000 startups, that's a billion. That's $1 billion dirhams. So yeah, it's important. So, Cicely, I'll leave it to you. Thank you so much. Really grateful for your time.
Yeah, that's it. We have done the poll and majority is happy with the session. Thank you so much. There's been a lot of, I think, great insights. I've been getting comments and WhatsApps and saying great content. We should put bites of it out there in social media. So we'll make this available later as well, but for the time being, have a great evening and all the very, very best for the future. I mean, there's a lot out there for you guys from what we've heard today. And
thank you.
Thank you very much for the opportunity.
Thank
Thanks.
you so much.
Thanks, Kushal. Thanks, Cicely. Thanks, everyone.
Bye.